That might sound pretty normal, right? There's a lot of those softwares out there. We think ours is very powerful. What makes ours unique is that it's going to be totally and completely free to all advisors. And we believe that there's a big gap between the type of analytics and understanding that advisors have access to based upon what they've paid to get, right? So these softwares are expensive, or certain broker dealers have something. So we want to begin kind of leveling the playing field, if you will, on from a technology perspective, starting in July.
Welcome to episode 37 of the Innovating Advice Show. I'm joined by Chris Shuba, founder and CEO of Helios Quantitative Research, which provides algorithm-driven turnkey investment management solutions. In this episode, we're chatting about how Helios is innovating advice, not only through their quantitative research, but through Helios integrated planning and additional tools that will be rolled out this year. And while I'm always looking for technology that works across borders, which Helios embraces, what I appreciate most about Chris is his mindset and approach to creating tools that help to level the playing field and how he's always looking to continually evolve. Links and show notes at innovatingadvice.com/episode 37. You're listening to the Innovating Advice Show, and I'm your host, Kate Holmes, bringing you the global pulse on financial services innovation, featuring financial planners, financial advisors, and related professionals from all corners of the globe. Let's dive in. Hey, Chris, welcome to the show.
Hey, thanks for having me.
So, Chris, I always love knowing where names come from. And so you've got sort of this Helios brand with a couple of different businesses, and you're going to keep growing. And we're going to talk about a few of them here today. But I want to start with, where does the name Helios come from?
Yeah, that's a very near and dear story, because it represents kind of like life or death for me. So it's a super long story. I'll give you the really quick version, but the quick version is that pretty much every name in finance has been taken. Yep. So as I was digging through names, I was looking for something protection oriented, and I started thinking about different shields that might be famous. So Excalibur is a famous sword. There were no famous shields, but along the way, I ended up finding the god Helios, right, which is the Greek god of the sun. And through his skill, he drives the chariot containing the sun through the sky, and he doesn't let the world burn, right? He kind of protects the earth. Yeah. And I thought that was kind of a cool idea, and for a number of different reasons. But I was at a conference in Costa Rica at the time, and we went deep sea fishing that day, and our boat broke down like 20 miles offshore. There's like no real Coast Guard or anything. So you just bob around floating out to sea. We bobbed for 7 hours before some other boat just happened to come along and rescue us. So I swore when I was baking under the sun that if I survived it, I was going to name, the company Helios as the god of the sun. So that's how it happened.
That's wild. So Chris, being a tech company, and listeners might be wondering, okay, we're going to be diving in, talking about investment management. And I've long said, when I started Belmore Financial, the company I had a number of years ago, I didn't do assets under management. I've had other people reach out to me, wanting to talk about investment platforms. Honestly, it's not the most interesting area to me. I'm far more interested in, really helping clients, looking at the things that we can control. And we know we can't control the stock market. And boy, if we needed a reminder of that, everything that's going on during this pandemic is a huge reminder that we have no idea what's going to happen, not always rhyme or reason. So I want to talk about sort of why you started Helios Quantitative Research. But first, I'm going to ask a bigger question. How are you and Helios innovating advice?
Oh, how are we innovating advice? Advice is the big topic, right? And innovation has another synonymous word, and that's called disruption, right? Yes. So innovation, I look at as improving something that already exists, right? Innovating beyond it. Disrupting kind of means burning something down and building something new. And I get their similarities to them. But when we talk about what advice is doing now and how that's getting better on the existing idea of advice, that's where you're getting into things like the usage of technology and far more scalable and efficient business models. When you talk about disruption, that's where you get into pricing and what are things worth and how do you deliver that in a way that has never been delivered before, making it easier and less mystic to everyone that's out there. So
Yeah.
when we get into the idea of innovating financial advice, at Helios, all of our clients are advisors. So our advisors are the ones that are actually distributing the advice. And our role is about taking kind of an institutional process and finally making that available in the retail space. And that gets into a little bit more of a complicated topic around the idea of risk management. So our innovative space is, how does risk actually get managed in a client portfolio in a way that is simple and easy for an advisor to implement through their practice, that then adds more scale and efficiency, and therefore they can do everything at less cost. So sometimes innovation becomes disruption and disruption becomes innovation. So it's a big topic. Let me do this. Let me throw a question back at you so that I don't bore you and all your listeners with this. But in a specific area, knowing what you know about us, when you think about innovation in our world, what's the one area you want me to hit on, and I'll drill in deep for you?
Well, to me, it would be thinking back to when I started Belmore and talking with a lot of listeners that are from all over the country. I've now got great listeners in 45 countries, talking with a lot of them regularly. And they often are looking at maybe starting their own businesses. And when you think about that, taking the leap from maybe working in a really large bank or working in an investment house or as a product salesperson, there's a lot to think about when thinking about starting a business. And one of the pieces, I always say it's a piece of the puzzle, that investment piece, but it really is only one piece or section of a bigger puzzle. And we've spent so long in this industry where that was the value proposition that so many advisors had is, hey, I'm going to manage your investments. We're moving away from that. And, as you just said, it really is more on the advice piece. It's more about the coaching, the talking with clients, like I said earlier, about things that you can control. And so I like the idea of investments. I don't want to say being on autopilot, but really reducing the amount of time that advisors are actually spending on analyzing investments. When you've got new clients coming in, looking at, they have investments in 6 different portfolios spread across, 5 different spread across 5 different custodians. That just gets messy and there's a lot of time. So what I really like, Chris, about what you're building at Helios is all the things you guys have done to simplify that process. And you talk a lot about bringing scale and efficiency to advisors, which is absolutely speaking my language. And you've talked about, less legal and compliance risk and having this competitive advantage. So let's look at it and have you walk us through. Let's say it's somebody coming from one of these big companies that may or may not have been all that involved in doing investment management in the past, looking to start their own financial planning business. And what would that look like if they engaged you?
Sure. That's a lot more specific. I can handle that one really easily. No, that's a great summary. And I tend to categorize advisors into 2 major groups, right? Those that look at asset management as something that must give them a competitive advantage, and those that look at it as something that's kind of a check the box type of a deal. And I've run into really good financial planners and advisors that go both ways, right? And in my opinion, if I put 100 advisors in a room and I say, what makes you different than the person next to you?
Yeah.
Write it down on a slip of paper. It's going to be service or financial planning, right? Well, then the question is how do you demonstrate to someone, if you're competing against another advisor down the street, who's really better at this, right? It ends up becoming salesmanship or a popularity contest of some sorts. And so we believe that in the world of innovating financial advice or disrupting it in some ways, we want tangibles. We want you to be able to go to an advisor or go to a client and say, here's exactly what we do in the asset management realm. It's different than the person down the street. And if that resonates with you, then that's a value add that we're gonna deliver to you, as well as, we're great at financial planning and we have great service and our people are amazing and all the different things that everyone says they have, right? And so there's very few tangible ways where you can compare one advisor against the other in today's day and age, because financial planning is just one of 3 softwares. Everyone either uses, Navaplan, Money Guide Pro, or eMoney. The outputs all look basically the same. So basically it's who explains them the best, right? And so we believe in a world for financial advisors that want a competitive advantage when it comes to the asset management piece of their business, right? That's number one. The second big leap is that we need to start turning asset management into something that people aren't afraid of anymore. A lot of advisors check out of that space because of all the legal and compliance risks that they could get themselves into, especially discretionary advisors. But when you have a mathematic or quantitative backbone to all the decision-making that goes through your investment committee, what you're going to find is that fear goes away, and now you have a much more efficient business model, right? You don't have to make a million phone calls to every client before you do something. You can document it and you can move on in a way that you feel highly confident about. And then the last one, from a scale and efficiency, there's so many areas here, but one example is if I've got a million different portfolios across 6 different custodians and all kinds of stuff, the prep and post process is a nightmare. Just preparing for one client meeting means you're sifting through however many holdings, doing all the analytics and so on and so forth. You have to think about each meeting before you go into it at a very heavy level. Whereas when you're running a consolidated model bit, you end up with a lot more confidence because prep and post is all identical. You have 17, 20 models to work from. You mix and match those in all kinds of customized ways. But at the end of the day, it's still just 20 models to deal with on the back end. Creates much better task efficiency ratios and much lower amounts of employees to client base. So normally, if you say every 100 clients I take on, I have to hire a new person. Now that number goes up to 150 or 200 and it expands margins. So when you talk about innovation, there's not a lot of innovation in the actual delivery of advice. It's about your surrounding advice with, so that your value prop is just simply more attractive than the people down the street. Does that make sense, kind of?
Yeah, it does. And I think when I think about innovation, that scale and efficiency is a really big piece of it. It's actually leveraging technology and engaging with technology in a way that you're saying, okay, this might have been my value proposition 10 or 20 years ago, but actually technology can do it better, faster, more accurately. And when the robo-advisors started coming out right around the time I started my last business, was something that I was like, okay, this is really great. But then as I dug in deeper, I realized a lot of them were, super biased, and the questions when they first started were just, how old are you? How much money do you have to invest? And, what's your income? And if you said, I have $10,000 to invest, it would say, great, you should invest $10,000. It didn't ask, do you have any credit card debt? Are you saving up for any short-term goals? And so, Chris, that's one of the things I appreciate about what you're building with Helios Quantitative Research, is that it is really being a closer partner with advisors and planners. And pausing for a second, the word quantitative is something that I think is
a mouthful,
gotten thrown around again. I've never been like high on the investment side. So what does that mean? How is quantitative research different from, a lot of the other robos or platforms that people might be thinking, oh yeah, other people do this too?
Yeah, good question. Quant's one of those words that people are afraid of, right? It's like 9 syllables long and spelling it's the worst. But the thing about quantitative approaches is there's so many of them. It's like saying the word car, right? There's all different types. Do you need a truck? Do you need a minivan? Do you need a convertible? What do you need, right? So in one end of quant, you can get into high frequency trading, high speed trading, lots and lots of activity, predictive analytics, and so on and so forth. That's one end of it that would be more on the trading quantitative side. We're more on the investing quantitative side. And so an easy way to think about this is every strategy that's really ever been created in investing is created by a bunch of smart people, right? A bunch of smart people get in a room, they say, hey, let's do something cool. And so you come up with all these ideas. And then the best ideas go through a very rigorous process of saying, does this work? Can we count on it? Does it do what we expect it to do? What happens when we shock it and make it do things that, that are bad in the marketplace? And is the results what we wanted to do when we designed this? Kind of like cooking a new recipe, right? You start off with an idea, you put some ingredients in a pan, you adjust from there, and you go on. Now, there's all kinds of problems with that. You could back fit something. You could take someone else's recipe and just make it perfect, right? If you know who you're cooking for. But the reality of it is we don't know who's going to sit at our restaurant, right? We don't know what's going to be there. And so you can't take the past and just apply it. You have to sit back and say, what's the best avenue going forward? And that's called back testing. Back fitting means you're applying what you know about the past to look perfect. Whereas back testing is you're taking a forward-looking capability and saying, well, what would have happened if we had done it before? Yeah. So you always know the difference between a back test and a back fit. When a back test is going to have some really bad parts to it, whereas back fits look amazing all the time. So just FYI, that's your little secret. But anyway, once that strategy that a bunch of smart people put together gets finished, that's where the fork in the road happens. You have a choice. You can give that strategy back to the smart people to execute. Except the problem is now you've introduced a whole new layer of risk called the human risk. Stress, fear, anxiety, all that now comes into play. And humans are ultimately unreliable when things get stressful. That's just the bottom line to it. So it went from smart people to being fully researched back to smart people. And now you've introduced risk. Instead of giving it to the smart people, though, what you could do is give it over to a computer. And as the computer says, hey, this is the best of humanity. This is as far as humans could take this thing. We dreamt it up, we tested it, and now we want the computer to run it. Because if we don't have the computer run it, then the humans are going to come back in and mess it up. We're going to have all this emotion floating around, and this isn't going to work out for us. So let the computer do it. And that takes that one more risk out of the problem. So if you look at why identical strategies, one's runs by human and one set run by computers, and why over time the computers compound at a faster rate, even though the strategies are identical, that's because eventually the human risk comes into play. And in short periods of time, the humans might win, but over long periods of time, the computers without emotion just keep grinding away. And that's the advantage that institutions have always had over retail. And one of the roles of ours is to take institutional strategies and finally make them available in the retail space. And ours are all just quantitative in that nature. So it's really, when you think of quant, at least in the investing space, it's just the best of humanity without the risks of humanity. So it's
I like that. That's
a
much less intimidating. I think we've seen in different movies and movies about Wall Street. Yeah, you've always got the quants doing their thing, and they've created some crazy products over the years. But I like that definition of it. So, okay, Chris, let's go back to sort of that avatar of who we're thinking about here as we walk through this to keep it simple. So let's say we've got someone, again, starting a brand new business, may or may not have a lot of investment experience. So does Helios already have sort of your preferred models, or where would they start?
Yeah, for us, it's we have different ways that we work with different advisor groups. So a big complex team would use us as a research provider and as an outsourced CIO differently than a one-person shop with maybe a staff person. So we have different ways of engaging just because we don't want to overwhelm a smaller office, right? So we definitely have that part taken care of. I would say that if I was going to give financial advisors who are just starting out a little bit of advice, number one is, in the old days of financial services, it was about building empires. You wanted to have this huge team photo with all these really smart people all lined up in a row. And those days are gone because it's very, very expensive to do business that way. And firms that have a lot more nimble business models can run circles around them when it comes to marketing and so on and so forth. So think lean and mean right from the very beginning, which means a lot of outsourcing. Right now, obviously, I'm talking my own brand here because the asset management piece would be outsourced. But think about how your technology locks in with each other. What is already built to work together? How do you outsource your compliance? How do you outsource your marketing? How do you do as little of the things that you are not specifically trained to do as possible? That's a piece of advice number one. Number two is I would, if at all possible, if you're going to get into this business, you're not going to want to start from scratch. You're going to want to buy a book from someone. You're going to want to work under someone, knowing that you're going to, buy that book at some point in time in the future. But starting with just a bunch of cold calling is next to impossible these days, unless you have a very, very differentiated story. So be planful about how you do this, and it will involve some risk. The risk will either be giving up your existing job and working for someone at a lower rate, or it will be taking on debt to buy someone's book, right? But definitely understand that there is risk kind of coming into this business. And then the third one is define what it is you're exactly targeting. If you go out to the marketplace and say you're built for everyone, you're going to be lost. What you need to do is find some specific group that you identify with. And something that has a unique culture around it. So a lot of folks say, oh, well, I'm going to get into socially responsible. Well, yeah, you should get into socially responsible. That's a big, big group. If you're a runner and you have a running community locally, you can build a heck of a practice just out of the 200 people that you encounter in your local running area. That's more about it. So find a niche and get really good at serving that niche to grow your book right away. I'd say those are the three big pieces of advice. One of which obviously is self-serving for Helios. The others are just my goodwill to you, so to speak. But yeah.
Yep. So absolutely, and all great advice. And so just on the investment side, though, when it comes to who would be sort of Helios's ideal client, and again, just keeping it simple for listeners, do you have sort of those model portfolios already set up, or do you work with advisors that already have all of their portfolios and strategies ready to go that they've been working from, for years?
We tend to get both. So very, very rarely do we have an advisor that comes to us and they have nothing. So most of the time, the vast majority of the time, they're coming from some sort of investment strategy. And so when we onboard a team, everything is customized to them. So we're going to take all their existing holdings and what they're doing, right? We're going to run those through what we call our WAR calculations. So this is our way of rating every mutual fund and ETF to see if we like it. And if we like it, we're going to tell you to keep it, because we want to reduce any capital gains distributions or taxation. We want to make it feel very comfortable to move into your new models. And having a similarity of holdings is something that we will always going to look towards. The other thing that we do is we make sure that any relationships you have get preserved. So an example would be, if you love working with, the Hartford or, PIMCO or whoever, you'll be able to keep those relationships. And so we'll look to fill any holes through the relationships you already have, assuming they have stuff that meets the holes we're trying to fill. And so when we come in and begin working with an advisor right away, we make it very comfortable to adjust from their existing models into their new models. And we make sure they map over pretty quickly. So we never really have an issue with that. If obviously someone's starting from scratch, we can start from scratch. But in our traditional advisor, I would say, is experienced in the business, but it really doesn't matter to us, their AUM, because we are a flat fee. It's whoever wants to hire us, right? And so relative to hiring a person, we're always less expensive than that. So it doesn't really matter what size the advisor is, but we do have certain pricing models based upon if they want to go with our full capabilities or if they want a slimmed down version of our capabilities because they're a smaller advisor and they want to make sure they maximize scale and efficiency. So we do work with advisors of different sizes. I would say the number one characteristic, though, about all of our advisors is they're all business owners. So they're either what we would call the independent channel, or here in the US, we would say the RIA channel. But they would be business owners. They're not necessarily employees. Generally, because we cost money, employees of other companies wouldn't hire us because then they're the one fitting the bill, not the company. So we normally work at the big company level, and that would trickle down to the employee type advisors. But our bread and butter is really any advisor that would consider themselves to be an actual business owner from a taxation perspective.
Yep, certainly. And so you are also holdings agnostic. I'm mentioning whoever people are comfortable working with, whatever investment styles, active, passive, ESG, you don't have any relationships with any fund houses that would create a conflict of interest. Correct.
Yeah. So we know all the asset managers, right? And they're all good people and they all have good stuff. And so we make it our business to really understand them, right? We have no financial relationships with any of them. And so we're just really careful to make sure that the advisor maintains what they have. So a lot of times, a advisor consultant or a wholesaler will come across an advisor and say, hey, you really should talk to Helios. And so then, that company will, give us a call and say, hey, this advisor wants to chat. Great. Well, when we end up implementing that advisor is generally pretty grateful for the, advisor consultant or the wholesaler that referred them to us. So oftentimes, everyone wins, right? The advisor wants to keep working with that asset manager. That's great for us because the asset manager now, gets rewarded. And so everyone kind of wins in those regards. So we never really have any issues with not having any bias whatsoever. They all tend to work themselves out, but we like being totally agnostic. And the reason is we just don't if you think of algorithms, they're like mannequins, right? You can put different clothes on them. So if I have an algorithm or a model, and I want a total return set of holdings, I can put total return focused holdings on those. If I want socially responsible, I just put socially responsible clothing on the mannequin, or biblical, sure, go ahead, or tax friendly, whatever. Having frameworks is what we do. We build the mannequins, and then we work with the advisor to dress the mannequins in ways that they find appealing, right? But to us, it's one shirt versus another. it is what it is. So was that a horrible analogy or did that work out all right?
No, I like that. I'm a very
right.
visual person. So having that visual element is super helpful. And again, it simplifies it. We spend so much time in this industry with complex jargon and talking about, crazy topics that often go over a lot of people's heads. So I like keeping it simple and visual. So Chris, I also want to make sure we chat about another one of your projects or brands is Helios Integrated Planning. And this is another area where you guys are innovating advice and looking at, okay, there's the way that things have traditionally been done. Where are there gaps? And you identified a gap and you're filling it. So walk us through what Helios Integrated Planning is.
Yeah. So as you think about the advisor has some major pillars of its business, right? So the first is going to be asset management, right? Whether you love it or hate it, it pays the bills, right? In a lot of different ways for most advisors. Then there's financial planning, right? And if you're not making your money through asset management, then you're making it through financial planning. And then the third leg is insurance. And I wanted to make sure that at Helios, we were constantly adding value as we kind of made our way through these different legs. So the first one was the advice or the asset management, right? How do you create a scalable, regulatory and compliance friendly competitive advantage in the asset management space? So we kind of got that with HQR, Helios Quantitative Research. The next one was, well, a lot of our advisors are all financial planners. How do you innovate in that space? And as I said before, everyone uses the exact same softwares. Everyone talks about it in identical ways. It literally just becomes a sales pitch. And we wanted to adjust that. And so one of the things that I noticed about financial planning that was a hole or a gap is in the estate planning world, because the financial advisor would know that there's a need for one, pretty much for every client, right, to be able to have control. And they would refer that to a local estate planner who would charge $3,000, $4,000, $5,000. And it would take forever and ever, and it would just never get done. And so what we figured out we could do is build a technology platform that would allow the financial advisor or the client, either one, to go ahead and enter in the information that's needed for an estate plan. And then our estate planners on the back end would review that, make sure it's good, and turn it around within 2 business days. So that now the advisor remains the quarterback, if you will, for the entire estate planning process instead of losing that influence over to someone else locally. And the advisor becomes the center of the inheritance conversation. And that's a big deal because somewhere between 75 and 90% of all the wealth will leave a practice once the second spouse dies because it gets distributed to the kids. This creates an environment where the kids will get get relationships with that advisor many years before they normally would have, and then ensures that that wealth stays put. It also creates an entirely new revenue stream for the advisor because they should just refer that business out. Now they get to keep it. And so most advisors will then increase their ongoing financial planning fees to cover the estate planning work that they are now coordinating. But from a regulatory and compliance perspective, Helios is the one creating the documents. The advisor gets to pick who's entering the information into our system. The advisor also gets to pick how much of the who pays for it. So all the compliance piece can be easily worked out. It's just a question of what the advisor is most comfortable with. But yeah, it creates a whole new revenue stream and much more control for the advisor. So.
That's awesome. But one of the things, and I know this is a very American way of looking at it, but there are definitely compliance things in other countries, is around any legal risk of being even perceived to be giving legal advice as you're talking with clients about, an estate plan and what needs to go into it. How do you cover that?
Yeah. So with the 2 major components that we have to deal with are who pays for it. And so the advisor gets to pick, and who's entering in the information. And once again, the advisor gets to pick between themselves and the client. So the big kind of legal hurdles are an option that you can pick on who actually engages. But then the last one is, giving legal advice. The funny thing is most advisors are out there running around giving legal advice all the time. They don't even know it. So they have to go through our training before their account is active with us. That oftentimes solves a lot of that problem right away. But our system also prevents advisors from doing any estate plans that are overly complex that would normally be contested. So the vast, vast, vast majority of all contested plans have a very set, similar bunch of characteristics such as disinheriting a child or trying to leave $1 million to your dog or something like that. So our system automatically kicks all those out and won't let the advisor even try to do them. And then at the same point in time, our system makes sure that anything that might be weird along the way gets red flagged. So our main interest is that 85% of estate plans that are fairly basic and vanilla that just need to get done from a financial planning perspective. And so that's really where we live. All the ones that normally would have any sort of legal advice risk, we won't even let them do. And then we have a team on staff at all times. So our software platform is built in with all the tips and tricks that would be needed to answer any questions the client might have along the way. And then, of course, we're on standby at all times anyway. So legal and compliance risk, we have multiple ways of managing through it. But for the amount of new revenue that it drives for advisors and saves revenue from assets leaving the business, everything you do in business has some form of a risk. We've just done all the things that make it very, very low risk relative to the amount of upside that an advisor could have. So, but we love it. Yeah, we're onboarding hundreds of new teams every month at this point, and it's kind of fun to be disrupting that into the business.
That's awesome. So Chris, a big question is, because I'm all about finding tech that works around the world, and one of the things I hear from advisors around the world is, hey, there's tech available, in Australia or in the US or in the UK, and there isn't always all these options around the world. So between both Helios Quantitative Research and Helios Integrative Planning, what would that look like for advisors around the world to be able to use?
Yeah, so on the HQR side, or the quantitative research side, we've already started doing a bit of dabbling in Australia. So if you're in Australia, certainly would love to talk to you. And it's just a matter of licensing and just being aware of what we need to do on our end to be distributing our work elsewhere. As in Australia, we have versions of our models that would trade on American exchanges. We have versions that would trade on the ASX or the Australian exchanges. So we can build things out of the local capabilities as well to be mindful of taxes. So, but it's just a matter of opportunities and making sense when we go over there. So, our goal is to be as flexible as possible in that regard. On the estate planning side, it's more or less the same thing. So right now, all of our data systems or everything are built in English. So we would prefer English speaking at this stage because obviously it's my main language. And we'd have to find the right partners over there on the legal side to make sure that the documents that are built are right by city or province or county or municipality or whatever they're named in that jurisdiction. So we would need partnerships to expand the technology, but we're always willing to do it. I think that's kind of what makes technology cool, is it can go between borders pretty quickly.
Yeah, totally. And so where to from here? You guys are building out all kinds of things. I know you've got plans for the future. So give us a little peek into what's next for the Helios family.
Yeah, the peak is that in July of this year, we're going to have a new software platform come out based on helping advisors understand the risk profile of their clients, doing a analysis of their existing portfolio, and then being able to compare that existing portfolio to some other portfolio in a competitive situation. That might sound pretty normal, right? There's a lot of those softwares out there. Yeah. We think ours is very powerful. What makes ours unique is that it's going to be totally and completely free to all advisors. And we believe that there's a big gap between the type of analytics and understanding that advisors have access to based upon what they've paid to get, right? So these softwares are expensive, or certain broker-dealers have something. So we want to begin kind of leveling the playing field, if you will, from a technology perspective, starting in July. So the first version of that will come out. And as mentioned, those are going to be the major components. By the end of the year, we've added a ton of new functionality to it that'll be pretty cool as far as helping advisors, again, raise above the current issues related to, regulatory compliance, business risk, and so on and so forth as it comes to understanding their book, understanding where risks are, running a much more efficient investment committee process, and so on and so forth. So we have some technology coming out that's going to be really cool. And like I said, it's going to be something that's free to everyone to use. And so that'll be pretty disruptive because there's a lot of software companies out there charging a lot of money for something that does less than what our software platform will be doing. So that's the next big thing. And so from then, I think we might take a little bit of breather as far as brand new things coming out and just kind of enhance what we have. But I'm certain there'll be more to come. We'll see.
That was a bold statement right there, Chris. I love it. I'm super excited to see how that turns out. So any final thoughts for listeners? I'll make sure to connect to your LinkedIn and the Helios Quantitative Research website and the Helios Integrative Planning website. But any other final thoughts as advisors kind of look forward at what the future of advice might look like?
Yeah, I mean, one of the things that I say to advisors is that, kick a lot of tires. If you're thinking about what's next for your asset management capabilities, if you're thinking what's next for your financial planning capabilities, companies like us are designed to be very upfront about what it is they do and who they help. And so companies like us aren't the kind that are going to anybody who calls us, we don't say, oh yeah, thank God, here, sign a contract. We're very interested in making sure that advisors that work with us, since 2013, obviously we've worked with a lot of advisors, and with the exception of one who isn't in the business anymore, every advisor that's hired us still works with us. And that's because we're very, very upfront and honest about the types of advisors that we're really interested in supporting. And so if you are thinking about, your asset management world, if you are thinking about estate planning, if you are thinking about technology, give us a call and talk to us. If we aren't the right fit for you, we'll tell you where in the industry you probably should go. If we're a great fit for you, we'll try and tell you why. That's right. That's what sales is. But a lot of times, especially advisors that are part of really entrenched teams, they don't pop their head up too often. And advisors that are new, they don't know where to go. So use companies like us to understand what it is we're doing, why we exist, what you may or may not be missing. And like I said, we're always going to be really upfront with, if we're the right fit or not. So just FYI that, don't be scared, give us a ring. We'll chat with you like a human being would. And that'd be my final piece of self-serving advice.
Perfect. Thank you so much, Chris.
Yep, no problem at all.
Thanks for listening to the Innovating Advice Show. I'd love to hear your thoughts, so make sure to connect with me on LinkedIn and shoot me a thought or two. Link to my profile is right below. Stay safe, stay well, and I look forward to hearing from you.